Good afternoon, everyone, and thank you for joining our fireside chat on the uranium session today. First, I'd like to make some introductions. From Sachem Co., we have Mike Alkin. He's their chief investment officer and founder of the company. He has over 20 years hedge fund experience on both on the long and the short side, with extensive short selling experience across many industries. And he's got a contrarian and deep value investing approach. So, Mike, say hello.
Hi, everyone. Thanks, Dave.
Yeah, and from Seeger Capital Management, we have Adam Rodman, founder and chief investment officer. Before founding Seeger, Adam was a partner and senior analyst at Corriente Advisors, where he specialized in emerging market and commodity-related cross-asset investments. And he started his career at Bank of America in global corporate and investment banking. Okay, and we also welcome Arthur Hyde, partner and portfolio manager, also from Segra. He previously held several roles at JP Morgan's investment banking division, largely focused on fixed income, credit markets, derivative structure, debt capital markets, and as a credit analyst covering municipal and nonprofit clients. Okay, and unfortunately, due to a family emergency, Marcelo Lopez from L2 Capital Partners cannot be with us today. So our theme today, why uranium investing is now different. So, I think we have this perfect storm. ESG investors are taking notice. Uranium's finally getting recognition as a green energy source, and it's getting a lot of support from the US government, both for nuclear and for the uranium sector. We have demand for physical uranium increasing significantly, both by investors and for the first time that I can recall in covering the sector for about 15 years, by uranium companies. My estimates, over $1 billion has been raised this year already by uranium companies, and we think that at least 40% of that is earmarked towards physical uranium purchases. So, to kick things off today, let's talk a little bit about this clean energy transition. We've got Biden's $2 trillion infrastructure plan, certainly positive for nuclear. It's a recognition that nuclear is a key source of baseload clean energy. And more recently, the feds have stepped up with tax credits that might help ease the financial burden for some of these reactors. So why don't we start here our discussion on the clean energy transition? And does this entirely ESG landscape change the rules? Is this a large reason why some uranium stocks are catching the bid here?
I can jump in. I think the short answer is yes, not just in some high level way, but also because from a policy standpoint, both in the US but internationally, it's become clear as emissions targets, carbon neutrality pledges, et cetera, as those have become more serious, as a consequence, nuclear's role in that energy transition has also gained much needed esteem. So it's both the idea that it is a climate transition investment or trade generally, but also the math of how we achieve the emissions targets we have out there is actually getting held we've been held accountable to try and achieve those goals. And as at least I think the three of us on the call, the four of us believe, it's pretty difficult to do that without nuclear. So it's gotten a new place in the limelight as a result of that.
Yeah, I would agree. And I'm just happy that it's starting to come, because for the last 4 years, friends and family think you're crazy when you're talking about, no, really, nuclear is clean, it's safe and all that, and it's friendly. But people didn't always believe that, right? But it is catching a clean energy ESG bid, and exactly what Adam said. It's just simple math, as Adam and Art always say, and we say it's fourth and fifth grade math. If you want to achieve these goals, that's what you need nuclear. It has to be part of the mix.
Mm-hmm. Yeah, and I asked this question earlier today. The Trump administration has always been supportive of nuclear power and more recently uranium. Does support being provided by the Biden administration bring a different kind of credibility to nuclear power? Essentially, does this help the industry attract a different crowd than it has in the past?
I would say the Trump administration was vocally very supportive of the nuclear industry. In terms of what they actually accomplished in 4 years, if you talk to people in the industry, I'd say they're more questionable, right? So the rhetoric was always there. We certainly had the 232 dialogue, we had the working group dialogue, we had very vocal support from the Republican Party that nuclear should be part of the mix. But again, we didn't really make much concrete progress. I think what's unique about having the Biden administration being vocally pro-nuclear is that it makes it a bipartisan issue for the first time in 40 years. Most of the solutions for nuclear will be battled in Congress. While the administration can do some things, and certainly lending their weight is a big step, we're really talking about congressional bills that will end up supporting nuclear. I think forms a question here. Obviously, anything that's anti-carbon helps nuclear. But I think that the fact that it's a bipartisan issue, and you have Senator Joe Manchin on one side pressing for it alongside Republicans, I think it's a completely different game than it was in 2016 and 2017, when Republicans were arguing for the industry and Democrats really were solely focused on renewables.
So
and the Democrats might have just opposed it just because Trump supported it and the administration supported it. Right? It was easy just to say no because they didn't like him and they didn't like what he stood for. Whereas now it's very different.
Yeah.
My view on this is that it's always which driving stick is the biggest, and I think nuclear. It's easy to unfairly malign nuclear relative to the rhetoric and the marketing that has been around renewables for the last several decades, if there's no consequence for failing at an environmental goal. If it's really more about what feels good, I think the world has kind of been satisfied with increasing spend and growth in renewables participation in various grids globally, but at the consequence of rising emissions and higher electricity costs. With kind of a dual mandate to decarbonize and keep electricity affordable globally, nuclear enters stage right. And again, it's just that there's a bigger stick out there forcing policymakers to recognize the benefits of this particular technology, in that now, right, in many cases, we have legally binding carbon targets. And so if there are actual consequences, kind of the math and rationality will trump, again, some of the maligned, incorrect facts about the technology, nuclear technology, that have existed for the last several decades.
Mm-hmm. So do we actually think that the Republicans and Democrats can get along in this next session? Is this still going to be a bipartisan policy that they've put together and they're going to work towards the same goal, or do we think that there's going to be some friction there and things will get delayed?
I can almost guarantee there's going to be friction there. I think arguing whether Washington will come to a consensus and sing kumbaya is probably above our pay grade. But what I would say is, of all the issues out there, nuclear, it has the real opportunity to be an olive branch, right? It's zero carbon. In certain states, it's monumental to their carbon footprint, right? Look at Illinois, look at Pennsylvania. If we have a big setback in nuclear in those states, I mean, put the federal government aside, there's also state level targets, right? There are also utility level targets. Grant Isaac always says, and I think it's 100% right, that policy is often set by politicians, but it's carried out by companies. And I think for the first time since we've been looking at the space, those are very, very much aligned when it comes to supporting nuclear. When Exelon, when Duke, when they talk about their 2035, 2040, 2050 targets, every single one of them says that without nuclear, they can't hit them. So for the first time, again, we're focusing a lot in the US, which I think for the broader nuclear story is maybe a little less important, but it is a right tail risk to when we certainly underwrote the thesis in 2016, 2017, where a world in which everybody is focused on 2035 and a carbon neutral grid in the US was unthinkable.
Okay. Do you think these US government policy changes are enough? Do you think there needs to be more done by the federal government?
I mean, that I'll jump in because I think that's a hard question. I think I can see in the chat here as well, how many kind of reactors do we need to build in the next 10 years to move more favorable policy? I think this is a misconception amongst investors or people that watch the space, The expectation already right now is that we're going to shut plants in the US, about a dozen over the next several years, and estimates of up to a third over the time frame that Arthur laid out, the time frame under which we're supposed to be meeting carbon neutrality. So the fact is that a flatlining in our reactor count is a huge bullish turn of events for the sector relative to what's expected. When we often talk with people, I think the general kind of gut reaction is, economies are growing, which means that every generation source kind of grows underneath that growth. And so the question is, how rapidly do we have to accelerate for it to make an impact? Make no mistake, nuclear is anticipated to be a shrinking industry in the United States. And any policy that even just supported it at the status quo would be an incremental positive to numbers.
Yeah.
Mike, you're muted.
Sorry, or even reduce the rate of decline, right? So because it's in the numbers for it coming out, it's in the estimates for how much uranium is needed. So, and you've seen support from the states coming in, and if we never built another reactor, it doesn't matter here in the US.
And I'll just add one more point about how extending current reactor lives in the US can kind of have a more impactful place in the market versus a new build in China, right? Let's say China breaks ground on a new build reactor, demand is out in 2026, 27, 28. When you suddenly decide to extend the lives of Bayern or Dresden, not only are you creating demand in the very near term, but you're also giving certainty, right? A lot of it is not just saving the handful of plants that could be on the chopping block. It's also looking at plants that are reaching 40 years of age, 60 years of age, and saying that we think they actually have another 20 years of runtime. If you're a utility and you think that you might be closing your plant in 8 or 9 years, you're way less focused on contracting, because conceptually you can maybe depend on the spot market for a few years. And then on the back half of your reactor, you're actually just drawing down inventory, right? So you're not thinking about recontracting on a 5 to 10 year basis. If all of a sudden you have a 20-year outlook, I'm thinking of entities like Excel, et cetera, you now really have to think about security of supply. And so while it may not sound like much to talk about reactor life extensions versus new builds in the US, in terms of near-term impact in the market, it can oftentimes be much more important. And I think that's why some analysts have gotten more and more excited as they look at the outlook for the United States.
Mm-hmm. And even with these recent tax credits, do you think this will help place the industry on a level playing field? Or is it too late to help Diablo or Indian Point or any of the reactors that are sort of on the cusp?
Indian Point, probably, just because I think we're kind of past due. Diablo Canyon, I'd say no. I think there's phenomenal grassroots efforts taking place in the United States. We've actually dealt with a lot of groups trying to push for saving that plant. It's obviously an important electricity source for the state of California. I think the statistics are roughly that closing Indian Point sets back renewables development in California by 8 or 9 years. So, we're talking about a huge, huge issue. There's obviously been issues with the governor when it comes to extending that plant's life, or I'm sorry, keeping it online. But no, we're talking 2024, 2025 shutdown. If Exelon is any guide to how close you can get to a shutdown before making a decision, there's plenty of time. Whether it's politically palatable in California, potentially a different story.
Okay, so we've been talking about economics here for a couple of minutes now. Is this really just a Western world issue? Does the rest of the world understand the environmental issue or the potential or the security of supply aspects to this story? Is that what we should be talking about a little bit more?
I mean,
Mike, you take this.
Security of supply. Yeah, I mean, it's, there's a lot of ways you could go with that. I think I see in the chat a lot of questions on the US, and I think a lot of that is looking in the rearview mirror. What Adam said earlier is there's a number of plants scheduled to close, and there's a ton of right tail risk in this, meaning good, because there's a lot of momentum for them not to close. So in the interim, you can hash out all this about the reserve and why somebody did this and they didn't do that. Doesn't matter, because those numbers are out of the equation. As for security of supply, yeah, as we look at the fuel buyers and utilities around the world, and we think about what the environment is like today versus we look back to prior periods and right before the last upcycle. If you go back to right before the last big move in 04, 05, there's a thing that rarely gets talked about when people like to present the inventory story. And inventory, right, plays a part in security of supply. And you'll see people put out charts that will show that inventories then were a little bit lower than they are today at the utility plants. What those charts fail to take into account is the 20 plus million pounds per year that were coming in under the megatons to megawatts program from 05 to 2013. A great guaranteed off-balance sheet source of financing for utilities and peace of mind for security of supply. Fast forward to today, you don't have that program. That ended in 2013. Inventories on both the commercial basis, not how some like to frame it, just utility inventories, but utilities plus suppliers, plus not having that big off-balance sheet number, they're well below an area where you would say, yeah, I feel really comfortable as a fuel buyer. So I think security of supply and where the sources of supply come from are something that you really need to think about, right? So for a Western fuel buyer. Anyway, Art, Adam, you have any thoughts on that?
I think I generally agree. Maybe the only other thing I'd address when it comes to security of supply or when we see utilities enter, there obviously, I think for good reason, there's a little bit of a preoccupation with when utilities see the cycle, as if that should be confirmation that investors are doing the right analysis. And I see Mike, nodding as well. So I think I'll speak for both Sachem Cove and ourselves, which is to say that don't focus on the price cycle as much as the capital cycle, given where we are. Is there enough capital today to meet something out into the future? Because obviously utilities are the critically important piece through the cycle, but they do need material. No one is arguing that they don't return to run rate material. It's always a question of when. Capital is supposed to be smarter. And capital is supposed to say, ahead of what we see as a worst case for when utilities are going to enter, incentive prices should reflect that need for capital into the future. And I think most investors who are looking at the space start coming around to the idea that we missed kind of our critical window for the capital cycle to reflect the future price cycle. And I want to bring that up in conjunction with the fact that uranium cycles usually don't start with utilities buying at the bottom. So don't worry too much about being right or wrong, depending on whether utilities are panicked today. The question is there a security of supply question in the future, given the capital pipeline that we have set up today and the price environment that we have today?
I'd almost go a little farther to say that if it sounded like utilities were like terrified today and the prices were at $30, we'd be in real trouble. The sense of complacency is a good sign. And I think for the most part, at least when we talk to utilities, I wouldn't say that most of them don't buy because they think they're going to be able to buy at 20. For the most part, I wouldn't argue that utilities think that the prices are going significantly lower. They can do math, they understand how a cost curve works. They're very intelligent people. And, as Mike said in a bunch of public interviews, and we totally agree, they actually know the asset base really well for the most part. I think the dislocation is whether there's an incentive in the market and there's an incentive in their seat to call a turn. And that's just simply not there. And that's how, as Adam said, in the past, they've been a little bit more reactionary to capital than the investment side has.
Okay, yeah, I think I want to come back to that a little bit later once we set up the price paradigm that we're looking at. So, back to the sort of the environmental stance here and the ESG stance does this really change the demand outlook for nuclear at this point? Or is this really just becoming a preference? Is this really going to build new reactors? across the globe?
I think it does have a real shift. I guess maybe starting, kind of with our backyard here. The shift in U.S. policy, especially the bipartisan shift, is very clearly, a result of new and more serious climate goals. Clearly, but let's not, scoff at China's net neutrality pledge and just how much growth in their nuclear industry is required for them to get there. Again, generally speaking, I would put it as, how big is the stick? How big is the incentive to push, let's say, less favorable technologies? And we'll be clear in admitting that nuclear, from a popular sentiment standpoint, is maybe less palatable as an environmental option than green, clean wind, or solar or hydro. But if the stick and the incentive are big enough, we have to go back to math and rationality. And that's really what ESG, I think, serves. ESG, or energy transition, or climate goals, however you want to say it. It's just that it's a very, very big stick, forcing the market, industry, and the capital markets to look more honestly at the viability of our different alternatives.
Do you guys think small modular reactors are really going to play a large role here? I'd say we've had small modular reactors in the nuclear fleets of the Navy for years, but when it comes to land-based uses and the prospectivity of there being thousands of them, do you think that's something we've got to look at now or down the road?
Mike's on mute.
I apologize. I'm having work done in my driveway, and I don't want the background sound to be done. From our perspective, and I think Art and Adam would probably agree with this, is these are venture stage companies, right? So from a public investing standpoint, it's tricky. There certainly is support for the advanced SMRs. There's research dollars going that way. I mean, there's countless number of technologies vying for positioning. From our perspective, it's all just additive to the nuclear story. It's not our view on nuclear as a contingent upon it.
Yeah, I mean, maybe sharing some perspective. So we sit on the drafting committees of the World Nuclear Association. We help put together the World Nuclear Fuel Report with utilities and with producers and other industry representatives. And the way that they've gone about it is to say that at this point in time, they actually can't really handicap exactly what an SMR looks like. And so it's very hard to model, right? You can say there's a certain amount of demand, we think, based on this type of fuel requirement and this total amount of gigawatts, but you're really making it up. And so the answer is, will it have an impact over our lifetime? I'm sure it will. Where will that impact hit? 2030 and beyond. And so for that reason, while it's certainly something that's important to an industry, right? It's something that will, I think, help nuclear grow in parts of the world where large-scale reactors actually just aren't needed, right? Because you don't need that much power. There's plenty of parts of the world where, if you can grow the TAM by having a smaller reactor, things become much more interesting. But in terms of breaking down what it does for uranium between 2021 and 2030, it's not going to drive the boat. That will be large-scale nuclear driven in the emerging markets.
The only thing I'd say is that the good news is that there's no consensus number that includes a single small modular reactor. So, if we're wrong on our timelines, that would just be incremental positives to the story.
So, yeah, you mentioned uranium and uranium pricing here. I guess we can transition into the uranium market here. I've asked this question today as well to Grant Isaac at noon. Uranium demand is rising, supply outlook is uncertain. Why did we start this year at $30, and why is uranium price up only 35 cents? It certainly doesn't feel like that.
All right, go. Jump in there.
I'll lead it off. So I think Grant's also said this a lot. Right now, we're in a surplus disposal market. So we always joke when we launched the fund, uranium prices were low 20s. There was nothing magical about the low 20s. There was nothing magical about bottoming around 19. There's nothing right about 30. Anything below a price that incentivizes or impacts supply is just the market trading in a range. So if you watch uranium over time and you talk to traders about this, they'll agree it tends to be incredibly range bound. And that's because traders will feel like it's cheap at 28 and feel like maybe they could turn a little profit at 31, and they'll trade in a range, trade in a range, trade in a range. And then something will come in, whether it's a mine flood or geopolitical event or Camco coming to market or something else, and it will reset. And then it will trade in a range, trade in a range, trade in a range. Until we hit, call it 40, 45, 50, all of these prices are equally irrational because they're not going to impact the forward supply and demand model. So the answer is, in a surplus disposal market where it's about who happens to show up with material on a given week, again, it may feel great, and Twitter's full of this. The price will move 50 cents, and it'll be bids and offers moving on quoted platforms, but nothing will trade, and stocks will sell off or stocks will rally. The answer is not to say that we don't watch the spot market, but we watch it for events that are impacting the broader fundamental thesis. And so I'm not playing down the question. I'm just saying that in our minds, 31 is as irrational as 25. And while we might move around here, it's going to take an event one way or the other to push us to a fundamental price level. And when we get that price discovery, that's when the thesis gets impacted.
So at what point do they take enough uranium out of the market to get to that supply demand, fundamental valuation? Hit the cost curve.
Mike, you probably deserve this, but I gotta take it because at least this is the Adam Rodman view of things. I'm so glad you put it that way, David, because we get posed that all the time. It's like, when does the supply run out? It's in my mind, it's really not the supply. Over the last many years, we can generally account for every pound that has come into the market. What we haven't seen, through this cycle yet, is a normalized run rate demand from industry. Last year was the lowest amount of contracted uranium, in the post-Fukushima years. So to Arthur's point, we haven't had an amount of demand to test the various levels of price sensitivity in the market. Said differently, with the amount of tepid demand that we've seen in the market over the last several years, we've pretty much just been testing the lowest cost, or in some cases, completely uneconomic, inelastic pounds that come into the market regardless. And so, as Arthur said, 25 is the same as 30. It's just where a certain buyer is meeting a pound that would be sold for 25 as likely as it would be sold for 27 or 30, or anything else. Okay, so demand. There are 450 some odd and growing reactors, right? They cannot exist in perpetuity on between 60 and 120 million pounds of uranium per year, which is kind of the range of spot acquired, or at least by our estimates, spot acquired and contracting over the last several years. That's not enough for reactors. No one would argue it is, right? So then you get to how far utilities are letting their contract book run down and how much they're willing to pull on inventory. And a little bit of that is the special sauce, and you probably don't have enough time to dig through it on this panel, but we think we're getting pretty close to the end of that. Anybody that was up here saying they could call it week to week or even month to month would probably be lying to you, but we're towards the tail end of that inventory draw and contract roll-off cycle. The benefit of the delay in recontracting and inventory restocking is that we've had price suppression and capital suppression for many years longer than we should have, which means that whatever the new normal and the new price regime is, it's probably going to stay for longer while we wait for capital and incentive pricing to return and balance things.
Okay. You mentioned new normal here, and something that's been getting a lot of attention lately: physical uranium purchases. I think the traditional physical companies such as Yellowcake and Uranium Participation, they've been busy, but we've been now seeing some physical buying from the uranium companies, and this is something new that I haven't seen in 15 years. Why exactly are the uranium companies buying uranium?
I mean, I think you see it's because it's a good investment for them. It's they're buying something that has very limited downside and what we would think very significant upside. Um, they recognize that they could use that as when they go to finance their projects, right? Because it's not going to move around much, and it's a good piece of collateral. And I think they're just taking advantage of a disconnect in the market. Look, we think, our view is the question that we always hear is, well, how come, like your question, if it's $30, well, I don't know, why isn't it 22? Why isn't it 20? There's all this surplus out there, right? With how come people aren't puking it all over the place? I think the point we need to get to here, and I think there's a new vehicle out there that's going to accelerate that. It really comes down to what gives, you've gone from this market where there are millions and millions of pounds every month available in the spot market a few years ago to now very, very tight and in the spot market. So these juniors went out and bought uranium, but had they all bought front month pricing, the Lord knows where the price would have gone. If they said, okay, we're just buying 1 month forward instead of taking delivery in late 21, early 22. Those pounds aren't there in the early months. So really what you're seeing now is, Art mentioned, the surplus disposal. There are some pounds that will always make it in, coming in from the Uzbeks, coming in from Olympic Dam, right? So as long as the traders have the ability to go out and secure a few pounds, do a carry trade, and get utility feels as though, there's pounds out there. There's been no competition for pounds. Adam mentioned demand. He's talking about demand and contracting, but really there's been no demand. This is the first time you're seeing some competition for pounds in the spot market, and it's taking it out. But there's a new vehicle that's coming down the pike that Sprott is bringing in, which will be a trust that's coming in, where you're going to see for the first time something this market has not seen in forever, which is people with a view that enable daily price discovery, right? So it enables Segra, Sachem Cove, whomever else in the world that has a view on the price of uranium to go out that day and buy it. And then that trust is going to have to go out and secure uranium in the physical market. And good luck with that. And so now, utilities don't have a birthright to pounds of uranium. They played it beautifully for many, many years, rather than recontracting when the price of uranium was going down and their contracts were starting to expire. The traders had the ability to deliver a carry trade a few years out. The fuel buyers didn't have to commit to long term. They could then get reset at lower pricing, but all good things come to an end. And they've overplayed that hand in our view. So now it's just churning around the bottom, trying to figure out in that fuel buyer mentality, well, geez, I put an RFP out for 300,000 pounds and I had 5 guys come at me with it. There must be a lot of uranium. No, those 5 traders are going to go vie for the same amount of pounds that they have to go buy in the market. So it's this psychology that there's these pounds out there. When these junior producers bought it, had they all bought, like I said earlier, in the front month, you would have seen prices go up much more. Now you've got competition for pounds. Good luck to the utilities.
And maybe I just piggyback. Even though, I think Grant shared a slight disappointment in the fact that the buying of the juniors wasn't concentrating in the front month, right? Because it would have been great to see how much material there really was there. The flip side of that is that a lot of those pounds came out of the fall. A lot of those pounds came out of spring 2022. And so in some ways, I'd rather have a tighter forward market. I'd rather have more price discovery, because once the front end tightens, you're going to actually see much more price momentum. The other point I'd make is just that, at least the way that we've broken down a lot of the junior fundraisings, it really depends on the name. Some people were taking advantage of open capital markets, for sure. Some people, and I'll just point out, Denison Mines, for example, great project, but does have, because of the nature of the project, there are, I think, questions about exactly when they're going to be producing. When this 2024, 5, 6, there is a permitting question mark. Now, I think they've made phenomenal progress there, but when you go to talk to a utility and you talk about contracting for material, the ability to tell them that, hey, if we're 12 months or 18 months behind our targets, we can actually still fill you, gives you a lot more negotiating power in the relationship. And so I think for specific projects, there's actually a true value driver to owning that material. That's not the case for all of the raises we saw, but in certain instances, it's also just a really smart management move.
Yeah, no, I completely get buying uranium now to essentially de-risk your startup. You know, you don't know when it's going to happen, and utilities will be more apt to then trade with you, deal with you, if you have that product in hand. I also see it as a, you know, the backdrop to the treasury. That makes sense if you need to want to go out and raise some debt to build that asset as well. But really, should producers be investment companies? Should they be buying product for speculation purposes when they should really be focused on trying to get the product out of the ground? It's a hard enough business, and wouldn't they
Listen,
be
I
just?
mean, you know, I think we have very good relationships with, you know, the management teams of our portfolio companies, and we're thrilled to have them use uranium as a cash alternative on their balance sheet. Here, you know, far below what we think is a long-term incentive price of the material. Arthur and I think Mike both alluded to the fact that the capital markets have been open, and I would just add that, you know, it feels like a lot of money has flowed into the sector over the last 6 months, but it really is a drop in the bucket. I mean, this sector is still tiny. The uranium commodity market is extraordinarily thin. You know, even if we're talking about hundreds of millions of dollars, that could barely satisfy the requirements of one very large macro fund that wanted to get involved in the space. I'm not going to make any predictions about how much money will or will not flow into the sector over time, but the important thing is that we have a vehicle to test and see, you know, that gives investors that option. And I tie that back to the juniors purchasing material, because that is simply a reflection of a small amount of institutional capital willing to give the sector as a whole money almost blindly, as long as it is somewhat correlated to the idea that uranium prices are going higher. And I do agree with Arthur, obviously, that it depends, you know, company by company, and it truly is a de-risking tool for development assets or care and maintenance assets that are closer to starting up. But let's take a step back and just examine the macro environment that allowed all of this to happen. It's one in which relatively large checks were written in a relatively blanket, open mandate way, just so that money could get put into the space. And I personally believe that should a vehicle, whether it's Sprott or another one, that allows for price discovery in this market, real price discovery in this market to take hold, you will just see more, you will naturally see more capital, you know, enter the space. Liquidity will pick up.
I mean, make no mistakes, the physical market in uranium is broken, and it has been. It's not a normal functioning market. And if you look at market structure and incentives, right, traders who we speak to, and some very nice folks, but traders don't have big balance sheets to express a view. So if they thought, wow, we're wildly bullish, well, they can't back that up with a view. So a lot of what they do is trade amongst each other and then do these carry trades. Where they don't participate a lot is in a contracting cycle. So as the spot price rises to a point that starts to get fuel buyers thinking we need to focus on production economics, traders become somewhat less important. So if you're a trader, where would you rather see prices go up or prices go down in that environment? You'd probably not want to see them rising. So the market is kind of tilted that way, right? In the broker average price that's reported, as Art alluded to earlier, the prices that are quoted every day, that's not, most of the time, it's not based on a trade. It's based on a couple of traders reporting to brokers what they would buy and sell uranium for. Really? That's not the last traded price, but that gets quoted at the spot price. So when you, and utilities come in when they come in, very infrequently. It's a very different story when you have daily price discovery. And that's when you're going to see how deep that market is.
And last point, I promised, because I know we've got a lot we want to get to, but let's also just look at, like, let's do a spring recap here. So there's all this interest in the space. there's this acknowledgement that this commodity is too cheap. A number of financings were done that drastically improved the balance sheets of core companies in the space. After that's occurred, there's capital that actually wants physical exposure. So Yellow Cake goes out. They are 2.5 times oversubscribed. They issue the maximum amount of shares they can issue without having an AGM or a special meeting, right? So they're tapped out until they hold a meeting with the board. They actually cannot buy more uranium, right? Pretty miraculous. Next, UPC trades to a 20% premium, 24% premium, and nothing's happening. I know for a fact that investors were calling them on a weekly basis asking what was going on. So it felt like investors couldn't gain exposure to the physical market in the way that they traditionally would. So I'm just laying that out to say this happened at a unique time where the traditional vehicles that should be reacting to investor interest and attracting capital inflows actually couldn't react. It turns out that UPC was probably negotiating the Sprott deal, and again, Yellow Cake was tapped out. So the question is, if that interest is still there, and the Sprott transaction, and obviously UPC had a very successful raise since then, but if the Sprott transaction closes and you see that interest, all of a sudden you're going to have a very direct pricing mechanism that you haven't had for the last 4 months.
So does physical uranium on the balance sheet of a mining company make that company more attractive to an investor? You know, I think Grant said something interesting today. Cameco is sort of backing away from carrying large inventories. You know, when they're dealing with the utilities, the utilities see all the product they own, say there's no worry about supply, we're not going to pay you too much. You know, does it send the wrong signal?
Sorry, the one thing I'd say is for Cameco, it's a working capital item. For these companies, it's an investment item. It's a completely different point of view. I'm not to disagree with Grant there, but I actually don't think utilities see it the same way. So from my perspective, there is a weakness to having high producer inventories. None of the entities we're talking about are producers, and for the most part are not very, very close. And so I don't know that utilities assume the same access to that material. And if they do assume it, at least from our point of view internally, we think they're going to be disappointed.
Okay, so
Dave, somebody's asking, how do you get daily price discovery in a broken physical market? You get it with a unit trust that's out there buying physical uranium every time people are in there investing in that trust, which you don't have now.
yeah, so exactly. We're seeing an evolution in physical purchasing, and essentially, you know, this is all now about Sprott purchasing uranium participation, the intention to convert it to a unit trust structure. You know, I think a lot of people originally saw that just as a rebranding or liquidity issue, but really, how important is something like this?
Adam, I mean, I've been hogging here, so, or Art, you want to?
Well, let's take a step back. I don't mean to throw any cold water on it, but just so that everybody who's listening understands, Sprott is acquiring UPC in its current form. There's an intention to convert it to a unit trust structure and to dual list it on both the Canadian and the US exchanges. There's a few steps there. But I'll answer your question, assuming that they've done enough work, they get the ball over the goal line, which is to say that they convert it to a unit trust. Even if it were just a unit trust in Canada, it goes a long way. But given how deep the US capital markets are, obviously a dual listing probably makes it that much bigger and that much more attractive. So with that disclaimer out of the way, we're now in a world where the current UPC is a unit trust structure run by Sprott. It's listed in the US and in Canada. And instead of being 400 or 500 million in market cap, Sprott markets it to try and be at least the equivalent of their other unit trusts, which have a lot of competition from ETFs and other open-end structures, which maybe would make them one of many options, whereas this would be one of one. Now the question is just how much capital flows in. You know, Arthur mentioned that the Yellow Cake transaction was multiple times oversubscribed. Frankly, every single uranium raise from the most far-flung junior exploration company all the way through to, again, UPC's recent deal was multiple times oversubscribed. So for compliance reasons, for reputational reasons, I'll let Mike Alkin pin the donkey on just how impactful it is and just how much money will flow in. But I think my professional view is that there is enough institutional capital has done the basic algebra that Mike outlined to say that prices won't stay here for the next several years. And several years might seem like a long time, but remember, this is an energy and mining investing environment where any growth market or any asymmetric trade, let's say electric vehicles or new solar or smart grids, requires at least a 5 or a 10-year investing timeline. So if we sit there and say, can't say month to month when the uranium market turns, but the 24-month outlook is extremely strong, well, that might as well be tomorrow relative to most other investments that you're underwriting today, which means that institutional capital can look at a direct market vehicle, a market that directly interacts with the uranium commodity. And I think there'll be a lot of support and demand, potentially a whole lot. Now, Mike, you tee off.
Yeah.
Now you give them the real
stuff.
It's
when Adam and Art started Segra, and we were with Sachem Cove, and you go back to 18, and it's geez, how much downside do we have? If we could figure that out, the upside takes care of itself, right? Because it's got to get to a certain price. But Marcello and Guy at Tribeca, there was just a few funds really focused on this. And I know I can speak for myself, my closest investor friends who I've known for decades thought I was either crazy or didn't ask a single, much more than, what they never asked what you liked. Why would you buy it? They just thought you're nuts. Those same guys, I can tell you, are asking me what they should be buying right now or what they should be looking at in the world of nuclear power. And they're seeing it in ESG, and I see it in the emails. And, this is, we've heard a lot about, there's false dawns before. Well, there were false dawns, after in the mid part of the last decade, when there really wasn't a great bull story. There was still some secondary supply in the market, and it was mainly retail money. You're seeing the institutions come here, and this arbitrage has been here between price and value and production economics for a while. But it really wasn't until 4 years ago that you started to see the seeds of supply discipline come in, because again, market structure, you were covered by long-term contracts. So producers were still exploring and producing and not cutting back. That just takes a while to work through the system. But the reality is now you have a market that supply, and I've said this before, and I don't mean to sound like a broken record, but that supply horse has left the barn, right? So we could be fighting over, as Art said, 31, 25, whatever. It's all silly, because the amount of pounds that are needed to meet the demand, that, as Art always says when he speaks very eloquently, this is very predictable demand for the most part. And just that alone, you need mines being built. When you want to take Riaz Rizvi, the former chief commercial officer of Kazatomprom, saying you need 2 of us. So don't, folks, all of you who say, you could just turn the spigots on, that's not true. You need 2 more of us. And even Tim Gitzel will recently say you need 6 more MacArthur Rivers, right? So the reality is you need new mines. Those mines needed to be already getting underway right now, and that's not there. So people, not seeing the forest for the trees, people will fight over, crumbs here in the spot market, when the real story is what's happening in the bigger picture. And institutions are coming into this market right now. And as Adam said, you're just starting to look at it.
I'll just add one little anecdote, because we were joking about it before the Zoom started. I think I got asked to present at the Red Cloud Conference on uranium 2 years ago in New York, and there was 27 people in the room. And I think when we got asked to present, we were like, "There's a uranium conference?" We were surprised by it. It was literally that uncovered, that uninterested. Investors just did not care. And today I think we have 1,000 attendees, and that seems amazing. That's a huge jump. It's amazing how small 1,000 attendees is. Like, people don't understand that. Yes, the market has moved, but the size of this market is still incredibly small. I mean, interesting capital markets times, but GameStop's still 12 billion. Dogecoin was 86. Could a couple billion flow into, I guess I'm not supposed to say it for compliance reasons, but if there was a vehicle to play uranium, which is a very necessary commodity well below the cost curve, could macro capital in an inflationary and commodity focused environment find that attractive? For sure.
And that's not in anyone's calculus. For reasons we are used it the other. One of the industry consultant weekly piece who people look to talked about this vehicle and said this could be very significant, essentially. You need to pay attention to it. And that is typically not the way they discuss the uranium market.
So the expectations are this is going to help tighten the market, drive up prices. How does it improve daily price visibility? What does maybe Sprott's active management bring that we haven't had before in the physical holding universe?
I think any answer to that is going to be a little bit of conjecture because the vehicle is not established. We don't know if the parameters are going to be exactly the same as the current trust structures that are out there. But generally speaking, what separates a unit trust, let's just say, from the holding company is that they have to actually hold in short order what is backing their unit trust. So said differently, if you are going to be a uranium unit trust, you actually have to have the uranium drummed and in your inventory or storage, backing the unit trusts, which all together own the material. And I'm pretty sure I'm correct when I say that the leeway generally given is about 30 days. So what does that mean? That means that at least for the material that the Sprott vehicle in theory is buying, the spot market for them is a 30-day market, when currently the spot market today is a 12-month market, as we all know. And I think Mike or Arthur, I can't remember, very eloquently talked about the kinds of gamesmanship that can happen with price when you have 12 months to deliver on something that might be purchased today, right? So topic number one I would address is that you actually shorten the delivery timeline. Grant, mentioned how, I don't know if disappointed is the right word, but he would have been excited to see all of the purchases from juniors happen in the front end of the curve. Sprott purchases, as best as we can tell, will all be at the front and as on demand as possible. The second thing is that you will have a persistent bid in the market. And I won't go through all the technicals of the way that markets work generally and how the uranium market works today, but it really does kind of trade on appointment. I mean, there are days, there are even weeks when nothing trades and prices just move around. And if real inflows of capital come in and effectively you have a vehicle with a mandate to perpetually bid the market at a level that is NAV flat to accretive to the structure. I'm trying to put this in kind of plain English without running through an example. It changes the way that transactions will occur here. So, I mean, maybe if I'm not boring everybody, I'll go through maybe a scenario. Let's say $10 million flows in to the Sprott unit trust. And Sprott goes out, they're trading at a 1% premium or whatnot. So Sprott goes out and tries to buy $10 million worth of spot material up 1% in the market. But the spot market's pretty thin. And right there for delivery within 30 days, they only get filled on $5 million worth. What I believe happens, to the best of my knowledge, is that they will stay bid at a price that is equivalent to their net asset value until they are filled. Overnight, they are likely to release a report to the market saying, we traded at this net asset value, but we hold this cash because we could only buy half of the material that we tried to source. And the equity market, where the unit trust trades, will look at that report and say, wait a minute, They just bought as much material as they could to $32, but they only got half of it. What that means is that $32 actually isn't the price of uranium, or else they would be filled. We'll push the unit trust up. And now the unit trust trades up another % or 2 or 3%, whatever the number is on that given day. And Sprott is allowed to raise their bid in the market again, the 2 or 3 or 4, and so on and so forth we go, not even taking into account that inflows might mean that they're buying more along the way. And sorry if that was a long-winded explanation, but that is why price discovery and a persistent demand, persistent bid in the market matters, because it starts setting ranges and limits that respond to demand for the material in the market immediately. And so market participants get a much better idea of how much material is going into the market and where and how much is actually getting filled on the back end. Sorry, that was a little more than I wanted.
Yeah, it's really great, Adam. And just go back to news flow. I mean, in the last, 4 to 6 weeks, you've had the European taxonomy issue where nuclear is now included. You've had the China 14 5-year plan with upside to demand. You've had New Jersey with the zero emission credits go through. You've had really positive news, and it's a yawner, right? Because why? You've got traders with no balance sheet who can't see past tomorrow, or that's not their job. And fuel buyers, it's just not what they do. They come in when they come in. Here, that news affects investors' appetite for uranium, which is simultaneously reflected in the marketplace. Whereas now, you might go buy the old UPC, you might buy yellow cake, and if it trades to a premium over a period of time, they then may go raise capital in it. I mean, it's the Pony Express, right? It takes forever. Whereas now you're going to see it daily.
And sorry, I know we're belaboring the structural issues of this vehicle a little bit, and maybe you want to get to the macro, but one other dynamic that I think is important is, as Mike and Adam have outlined, if we trade at a relatively slight premium, whether it's 2% or 4%, you are going to have price discovery for the first time. What we heard a lot initially, and what actually a fuel buyer asked us directly when the news first came out is, okay, well, if all of a sudden it trades at a discount, doesn't it become a forced seller? So couldn't somebody push down the price of it and actually impact the spot market? And in a thin day, maybe have a very big impact. And when we look at the other trusts that are set up for gold and silver, that doesn't tend to happen. And it's not rocket science. Sprott is incentivized generally in these structures to grow the vehicle. That's how they get paid. And so what you tend to see is very, very low bars to raising capital and buying the physical as prices increase. Which is, again, very distinct from how Yellowcake and Denison have operated the vehicles in the past. As you trade to a discount, there's actually a lot of frictional terms built into these structures. So I'd encourage anybody to pull up a prospectus from one of those structures. With the gold structure, I think if you want to actually withdraw cash, which in theory would be forcing the vehicle to sell material to give you that cash, you need to pay a 5% penalty. You need to submit a written request for that cash on the 15th of the month prior to the month you want to receive the capital. So they just create all these inefficiencies for actually selling material. And so what you end up with the structure is that it will buy material at a slight premium, but at a discount, it doesn't tend to lose material. It ends up being kind of a one-way volume-driven vehicle. And that's why if you look at other structures like this, and you look at the actual material held, it's aligned from left to right, down to up. It doesn't actually fluctuate the way that a NAV-based vehicle would. And I think if you're on the other side of that and you're competing with it as a buyer, it's something to be very, very aware of. Because whereas these vehicles have gained some criticism from market participants for potentially being material that would come back to the market at some point, we think structurally this takes that dynamic away, which should be, again, very bullish for price.
Okay, so if big funds or generalists or growing ESG money want to invest in uranium, there's only a handful of billion-dollar companies out there, but these physical element investments could largely be open-ended, right? As long as the investment is there, they could probably buy more. Would you expect them to go to Cameco or a physical uranium vehicle, essentially taking investment away from the rest of the sector, or would higher uranium prices feed back down and there's investment for everybody?
I mean, I personally think you'll see a little bit of it. You'll have the small generalist hedge fund come in who could play across the space. Some people want to take mining risk. They're fine. Some people will say, hey, I want to take, I want to buy the crappiest companies because I think they'll be levered the most when the market rips, right? So, and then others will say, I don't want any mining risk. I just want to go in and buy a physical vehicle. So I think it's kind of a potpourri of choices. And, once investor interest is, which we're starting to see, I think it's kind of like nuclear and renewables. People think it's either or. Well, actually, they're complementary. I think you'll see it here too. You'll see people look at different flavors.
I'd probably also respond that, we've seen, the first inning or two of the uranium cycle, right? If you happen to invest last March, you could have thrown a dart. You made money. That happens in the bottom of cycles. You see correlation one. Capital does not get deployed effectively. I think what's interesting for us as institutional investors that focus solely on the sector is the relative value optionality in investing in equities is so much more interesting today, right, than it was last March. I think to the extent your thesis is proven right, and it's institutional capital flowing in from here on out, and that's what we think is required. We think you need to finance these mines. We think you need more production over time. We think this is not going to be a retail commodity trade. We think this is going to be a real investable commodity bull market. Those investors are going to use an institutional framework. And so I think the only thing, not to throw cold water on what's obviously a very bullish outlook from, I think, both firms, we think asset selection, equity selection matters a lot. And again, that's why we launched as a long short fund. Not to talk too much about how we've done, but I think one thing we're most proud of is that we've actually made money on our short book year to date. Adam's eyes went up. We're not going to talk about that too much, but I think more and more as we go through the cycle, it's going to be that rubric that you use to get in the minds of institutional capital to figure out what assets do they want to finance, what assets, make it through a cycle and create real shareholder value. That's what's going to drive returns from here on out. It won't just be enough to say I'm uranium related. We don't think it's going to be that type of cycle.
Okay. Well, guys, we've run past our time, so maybe I just want to close it out here. We're at $30 today. What do you think spot price is going to be? So let's say at the end of this year, and what sort of incentivized price do we need? And I don't want to open that whole can of worms, but do we need 40, 50, $60? Before we actually get the ball rolling.
Mike.
Sure, 2-to-1 Seger to me. Dave, incentive price, you need $60 uranium, right, to balance the market. $65 uranium. Some people might say 55, right? But the market, because it's so broken. And we could spend hours as to really why it's broken. It doesn't balance nicely, right? It's boom or bust. And so 60, 65, but we model in the 50s and 60s, but would we be surprised to see it materially higher? No, that's just upside. Where it is this, look, if the Sprott Trust comes to fruition like we think it will, and it has the impact we have, we think that the spot price of uranium will be meaningfully higher at the end of the year than it is today. And we'll let the fuel buyers figure out where that will be.
So here's what we always tell people, because the two questions we get more than anything are, if you're so right, why is the price 30? And what's the price going to be? And the way we answer the latter is to say that the fuel buyers are in the driver's seat. And we actually tell them this at conferences, and when we talk to them on the WNA panels and stuff like that, we'll say, you actually are in control. To the extent you want to go out tomorrow and lock in a bunch of contracts with some really high quality assets, really high quality development assets, the core producers that are out there today, care and maintenance assets, if you want to guarantee that supply is profitable with the right price incentive, you can be in 55 or 60 or whatever the tipping point is to where we need to be in 2028, 2029. Or you can hang back and you can wait 2 or 3 years. And in 2 or 3 years, we might get to the point where we actually can't bring on assets quickly enough. and we can get to a point where you actually have real shortages, like we saw in conversion, right? The same thing happened. And then we're going to massively overshoot. We don't know exactly where, because at that point it'll be market driven, right? It'll be sentiment driven. But what I know is you're going to need to drive the price well in excess of its long-term stable level in order to incentivize worse projects that can get to market quicker. That's what we saw last cycle, and that's what likely happens again. So again, we tend to underwrite our portfolio on a path-dependent basis, to where if it's the former, more conservative bull market, the companies we do very, very well, but also have enough, optionality and tail positions where, if they choose the latter, we benefit.
Okay. Well, thank you very much, guys. We've had some great conversation today. Much appreciated. Mike, Arthur, Adam, I appreciate you guys joining us today for our Uranium conference.
My pleasure. Thank you for having us.
Thank you, guys. Yep.